Hi Kashani, good morning.
Good morning, sir.
Yeah, good morning. අද මම කතා කරන්න යන්නේ loan cost calculation and shares එහෙම නැත්නම් debentures. මේක හොඳට මතක තියාගන්න. මේ formulas ටික මොකද මේක මේ syllabus එකේ වෙනම තියෙනවා. නමුත් ඒකේ මේ සමහර information මැද නිසා මට ගොඩක් මේක ඔයගොල්ලෝ ඉන්ටර්නෙට් එකේ search කරලා බැලුවත් ඔයගොල්ලන්ට ටිකක් අමාරු වෙයි මේකේ තියෙන information හොයාගන්න. මේක හොඳට මතක තියාගන්න කියලා සමහර විට මේකෙන් ප්‍රශ්නයක් එන්න පුළුවන් ඔයගොල්ලන්ගේ question එකට. හොඳට මතක තියාගන්න. ඒ කියන්නේ දෙපාරක් තුන් පාරක් කිව්වේ මේ topic එකේ මේ calculation එක formulas ටික හොඳට මතක තියාගන්න. මේකෙන් සමහරවිට ප්‍රශ්නයක් එන්න පුළුවන්. තාම එහෙම decide කරලා නැහැ. සමහර ලාවට එන්න පුළුවන් කියලා මම හිතන්නේ. right. එතකොට මේක cost calculation නැත්නම් share debentures වල calculation එක කරන විදිය. පොඩි calculation එකක් තියෙන formula එක මතක තියෙන්න ඕන. right. cost of ordinary share. ordinary share මේ කියන්නේ ordinary shares වල cost එක calculate කරන විදිය තමයි මේ තියෙන්නේ. KE සමානයි DO 1 plus G divided by PO plus G. මේ ෆෝමියුලා එක මතක තියෙන්නම ඕන. හරිනේ. ඊට පස්සේ ආපහු කියන්න එපා උගන්වන්නේ නැහැ කියලා. මේ ෆෝමියුලා එක මතක තියෙන්න ඕන. ඔයගලන්ට තියෙන්නේ Google කරලා ඉවරලා මේකට අදාළ ගණන් දෙක තුනක් බලන්න. මේ explanations බලන්න කොහොමද තියෙන්නේ කියලා. මේ දැනට මේ ෆෝමියුලා එක මතක තියාගන්න. ඒතර ලොකු ෆෝමියුලා එකක් නෙමෙයි. KE කියලා කියන්නේ cost of ordinary shares. ඊට පස්සේ DO කියලා කියන්නේ ordinary dividend per share. ඊට පස්සේ G කියන්නේ growth rate එක. ඊට පස්සේ PO කියලා කියන්නේ market price per share. මේ ප්‍රශ්නයක් එනවා නම් මේ ඔක්කොම තියෙන දේවල් ටික මේ ප්‍රශ්නේ තියෙන්න පුළුවන්. සාමාන්‍යයෙන් මම AAT question papers I went through AAT question papers. So those questions, even chartered questions, they have calculated this. So try to understand. Again, I'm telling this slide already shared in the LMS, so you don't need to worry. මේක බලන්න හොඳට KE equal DO plus 1 plus G divided by PO. ඒක තමයි මම මේක තියෙන්නේ. මොකද මේක මේ definitions අමාරු මේ මට මම පැය දෙකක් විතර උත්සාහ කළා හොයාගන්න බැරි වුණා. නමුත් මේ වගේ ප්‍රශ්න මේ කියන්නේ advanced principles of finance යටතේ exams වලදී ටෙස්ට් කරලා තියෙනවා. ඒක නිසා සමහරවිට moderatorsලා මම කරන්නේ question paper එක හදන එකනේ. නමුත් මට පස්සේ moderatorsලා දෙන්නෙක් ඉන්නවා external intern. ඒගොල්ලෝ තීරණයක් කරුවොත් මේ වගේ ප්‍රශ්නයක් මේකට ඉන්ක්ලූඩ් කරන්න ඕනි කියලා මම දාලා තියෙන ප්‍රශ්නෙට අමතරව. ඒතර ඔයගලන්ට මේක දැනගෙන තියෙනවා. ඒක නිසා තමයි මම මේ ඔයගලන්ට කියන්නේ. වෙන්න පුළුවන් possibilities. ඒකට ලීසියෙම ලකුණු ගන්න පුළුවන් තැනක් ලකුණු 20 කිසිම කරදරයක් නැතුව. හරිනේ? මොන හරි ප්‍රශ්නයක් තියෙනවා නම් අහන්න. මම මේ ගණක් හදන්නේ නැහැ. මේ ඔයගොල්ලෝ මේකේ තව ইনফরমේෂන් හොයාගන්න තව අපිට කල් තියෙනවානේ. එතකොට තව ඩිස්කස් කරන්න ඕන නම් ඩිස්කස් කරමු. right. Let's go to next one. Cost of redeemable preference share. ඒකේ ෆෝමියුලා එක KP equal DO divided by PO. මෙතන මේ මගේ අතින් පොඩ්ඩක් පැනලා තියෙනවා මේ PO කියන එක. මේක ඇත්තටම මේ DO divided by PO. ඒ කියන්නේ cost of irredeemable preference shares කියන එක තමයි KP කියලා කියන්නේ. ඊට පස්සේ dividend for preference shares market price per share. දැන් මේ dividend කියන එක ළමයි ඕනම වෙලාවක preference shares වල කල්ැතුව කියනවා. ඒක මේ කියනවා 12% irredeemable preference shares කියලා. 14% එහෙම කියනවා. එතකොට ඒක අනිවාර්යයෙන්ම මේ ඒ share එකත් එක්කම ඒකේ තියෙනවා ගෙවන dividend percentage එක. මොකද preference shares වල ඔයගොල්ලෝ අහලා ඇති preference shares කියන එක අපොසෙට Google කරලා බලන්න preference shares කියන එක ordinary shares නෙමෙයි. preference shares mean අපරයක් ඉන්නවා ළමයි. අපරයක් ඉන්න. So sorry I had a call. Then එතකොට preference shares වල percentage එක අනිවාර්යයෙන්ම කියලා තියෙනවා මේ ගෙවන percentage එක. ඒක නිසා මේ formula එක හොඳට මතක තියාගන්න. KP equals DO divided by PO. Cost of irredeemable preference shares. Then DO mean dividend for preference shares. Then PO mean market price per share. Right. Third one. Cost of redeemable debentures. මේකට හරිම සරල formula එකක් තියෙනවා. KD equals K multiply by within bracket තියෙනවා 1 minus T. එතකොට KD කියලා කියන්නේ cost of redeemable debentures. ඊට පස්සේ K කියන්නේ interest of redeemable debentures. මේක free define කරලා තියෙනවා. මේකෙත් ඇවිල්ලා මේ debentures වලත් ළමයි ordinary shares නෙමෙයි. ඒකට ගෙවන interest එක කල්ලාතෝ define කරලා තියෙනවා. ඊළඟට tax rate එක. ඕක calculate කළාම මේ cost of redeemable debentures ඔය ටික එනවා. ඒක නිසා හොඳට මතක තියාගන්න මේක සමහරවිට ඔයාලට Google කරාට හොයාගන්න බැරි වෙයි. මම මේ දේවල් හොයාගත්තේ පරණ ප්‍රශ්න පත්‍ර කියන්නේ AAT සහ මේ Chartered Institute එකේ ප්‍රශ්න පත්‍ර බලලා. ඒවා තමයි තියෙන්නේ. ඉතින් මම දන්නේ නැහැ ඇයි කියලා ඉවරලා මේක මේ placing Google වලින් හොයන්න අමාරු. මේ formula එකත් හොඳට මතක තියාගන්න. KD equal K within bracket y minus T. Cost of redeemable debentures, then interest of redeemable debentures predefined, then T mean tax rate. Right. අපිට සිලබස් එක ඔක්කොම කවර් කරලා තියෙන නිසා මම බලාපොරොත්තු වෙන්නේ ඔයගොල්ලන්ගේ මොනවත් විශේෂ මේ රික්වෙස්ට් මොනවත් නැත්නම් තව මොන හරි ආයි රිවිෂන් කරන්න ඕනේ කියලා. ඔයගොල්ලන්ට තව ඇඩිෂනල් නොලෙජ් එකට අවශ්‍ය මේ YouTube අද ඉඳලා ඔයගොල්ලොත් එක්ක ෂෙයා කරන්න කියලා තමයි මගේ බලාපොරොත්තුව. ඊට අමතරව ඔයගොල්ලන්ට මොන හරි ප්‍රශ්න තියෙනවා නම් මම දීපු අසයින්මන්ට් සම්බන්ධව හරියට මාතෙකුත් නැහැනේ. ඒක මාත් එක්ක ඩිස්කස් කරන්න පුළුවන්. මොන හරි ප්‍රශ්න තියෙනවා නම් එක්ක chat box එකේ දාන්න නැත්නම් මට කෝල් කරන්න ඊමේල් එකක් දාන්න මොකක් හරි සඳහන් වුණත් අහන්න. මොන ප්‍රශ්න තියෙනවා නම් අහන්න. ඊළඟට මේ සීමා වෙබ්සයිට් එකේ තියෙනවා මේ present value table එක. මේක චුට්ටක් බලා ගන්න. මොකද මේක නම් ඔයගොල්ලන්ගේ මේ ඔයගොල්ලන්ට මම ඊට කලින් කියලා ඇති මේ ඔයගොල්ලන්ගේ assignment වලට අදාළ දෙයක්. මේකේ ගන්න ඕනේ මේ present value කියන එකේ මේ cumulative එක නෙමෙයි. දැන් මේක තමයි මේ තියෙන 101 2 ඔය ටික. මොකද දැන් මේකේ තව එහාට ගියාම තියෙනවා මේ cumulative කියලා. මේක ගන්න එපා. මේක ගත්තොත් ඉතින් වැරද්දක් වෙනවා. cumulative present value එක නෙමෙයි ගන්නෙ. ගන්න ඕනේ මෙන්න මේ උඩ තියෙන මේ දෙක. present value table මේ දෙක. ඒකත් මතක තියාගන්න. right. අපි ඊට පස්සේ බලමු මේ weighted average cost of capital කියන එක මේ explain කරලා
I
තියෙනවා.
think we should explore a few solutions.
Grammarly suggestions catch when you're
Weighted average cost of capital, in short, WACC. This seems to be one of the most intimidating concepts. Weighted average cost of capital, in short, WACC. This seems to be one of the most intimidating concepts in finance. Fear not, this video explains WACC in an easy to understand way. We will cover what WACC means, how WACC is used, how WACC is calculated in the WACC formula, and why the WACC formula is pseudoscience, in other words, of questionable value and potentially dangerous. What does the acronym WACC stand for? The WACC is the weighted average cost of capital. Weighted average indicates that we're going to apply some mathematics to get the proportions right. And cost of capital indicates an attempt to identify the cost of various types of capital. WACC is a calculation of a firm's cost of capital in which each category of capital is proportionally weighted. The WACC is often used to try to answer the fundamental question in life for both investors and businesses. Can we create value? Here's a diagram of value creation for both investors and businesses. On the left, an investor and a bank. They invest a significant amount of money in securities, buying shares in a company, equity, or supplying a loan to a company, debt. It's their hope, at some point in the future, to get a bigger bag of money out of the investment than what they put in. The money that the company has now raised gets invested in the company's operations, its assets. Same idea here. At some point in the future, the company aims to get a bigger bag of money out of the investment than what was put in. Another comparison we can make is between the return on the assets on the right of the company versus the return on the capital of the company on the left. How do investors identify the potential for creating value? Here's what many equity investors or their analysts would do. They try to forecast the future for a complex financial metric called free cash flow, and then apply discounted cash flow analysis. Let's take that step by step. Free cash flow is a function of other financial metrics such as revenue, margins, working capital, and capital expenditures. To learn more about how free cash flow works, watch the related video. Let's focus on the WACC part in this video. The solid blue line represents the historical actual results. The dotted line, the forecasted free cash flow. The black vertical line is today. The formula at the bottom is what the equity analyst is trying to fill. The value of a company today, indicated by V0 in the left of the formula, is seen as the cash that the company currently has, C0 in the formula, plus the estimates of future free cash flows discounted back using the weighted average cost of capital to their present value. That's where the WACC gets used. Put the free cash flow estimate for year 1 in the numerator, divide by 1 plus the WACC. Put the free cash flow estimate for year 2 in the numerator, divide by 1 plus the WACC to the power 2. Put the free cash flow estimate for year 3 in the numerator, divide by 1 plus the WACC to the power 3, and so on. The next step for the analyst is to use the enterprise value that he calculated in his model as the starting point for the estimated value per share of the company. Enterprise value minus outstanding debt is equity value. Equity value divided by the number of shares outstanding gives a model value of what a share in this company could be worth. This model value, based on assumptions and estimates, is then compared to the actual share price out in the real world. If the model value is $36 and the actual share price is $42, then the analyst would recommend to sell the share or even go one step further by shorting it. You could earn $6 by shorting or avoid losing $6 by selling if the actual share price starts behaving like your model. If the model value and the actual share price are the same, then do nothing. Hold. If the model value at $36 is higher than the actual share price at $30, then the analyst would recommend to buy the share. You could earn $6 if the actual share price starts behaving like your model. Market transactions based on this advice could then make the model value, which the analyst believes is the correct one, and the market value converge, assuming that the world stands still and nothing unexpected happens, of course. Let's catch our breath for a moment and zoom out to put this in perspective. A company tends to be followed by multiple analysts, representing different banks or investment funds. In the case of this specific company, 22 analysts have done their forecasting and financial modeling. If they do this at the same point in time, using the same information, and assuming similar levels of spreadsheet skills, how come their conclusions are so vastly different? Recommendations run all the way from strong buy to strong sell and anywhere in between, making the whole exercise potentially useless. How is WACC used in companies? Mostly in net present value calculations for investment projects. Here's a project with $1,000 investment today and expected benefits of $400 per year for the next 4 years. Those future values of $400 per year get translated to today's equivalent by putting the WACC in the denominator of the present value equation. The further into the future the $400, the lower the present value equivalent. Repeat this calculation for all the years in the scope of the project and then add up the 5 numbers to get the NPV. The regimen to create value in the corporate world: accept projects with NPVs bigger than 0, reject projects with NPV below 0. In essence, the same method as the equity analyst uses to value the company as a whole, but applied to a specific project. So how does the infamous formula work to calculate WACC? Here's the simplest version of it, assuming just 2 classes of capital, debt and equity. WACC equals the market value of a firm's debt divided by the market value of debt and equity times the cost of debt plus the market value of a firm's equity divided by the market value of debt and equity times the cost of equity. Remember the definition of WACC, a calculation of a firm's cost of capital in which each category of capital is proportionally weighted. So this thing about debt divided by debt plus equity and equity divided by debt plus equity takes care of getting the proportions weighted. The multiplication is with cost of debt in the first part and cost of equity in the second part. Let's illustrate this with a WACC example of a fictitious company. Debt is $250 million out of total capital of $1 billion, so 25%. Cost of debt is 4%. Equity is $750 million out of total capital of $1 billion, so 75%. Cost of equity is 16%. Multiply and then add up, and you get to a WACC of 13%. So where does this cost of debt and cost of equity come from? The first part is fairly easy to grasp. The cost of debt equals the interest rate that the company pays on its interest-bearing debt minus the tax benefit of interest expense being deductible. So if the interest rate is 5% and the corporate tax rate 20%, then the after-tax cost of debt is 4%. Then comes the more challenging part, cost of equity. At this point, I hope you'll say, what do you mean, cost of equity? Isn't the whole idea that equity holds no legal obligation for the firm to pay anything? No, says the economist. You should look at the opportunity cost of the equity capital. An investor doesn't have to invest in this company if he doesn't want to. He could earn a return elsewhere. Cost of equity is therefore a required return by shareholders for the risk they take by investing in this specific equity. And that's where the whole idea goes off the rails, as we start using historical statistics to predict the future, basically fitting a line to past data, hoping that this has any semblance to what the future might hold. This is what the CAPM, Capital Asset Pricing Model, prescribes. The required rate of return on equity equals the risk-free rate plus a market risk premium multiplied by a measure called beta. Let's take that step by step. Beta represents some historical level of sensitivity of a specific stock to market movements. Low beta means the individual stock is unusually insensitive to market movements. High beta, the individual stock is unusually sensitive to market movements. Let's view that in a graphical way. Beta on the horizontal axis, expected or required return on the vertical axis. The higher the beta, the higher the expected return. Economists then introduce the term risk-free rate to indicate the lowest point, the return of treasury bills, government debt. They then introduce market risk, which is the average beta of stocks, and give it the value 1. The difference between the risk-free rate and the market risk is the market risk premium. The expected risk premium varies in direct proportion to beta. Sounds reasonable and plausible, right? Here are the main reasons why I think WACC, and more specifically the underlying CAPM model that cost of equity is based on, is pseudoscience. You heard it right, pseudoscience, questionable or potentially dangerous claims and practices. First issue in the CAPM, the notion of risk-free. Risk-free should be defined as 0% risk, no risk whatsoever, an absolute certainty, a guarantee. A very safe security like treasury bills is very low risk. However, very low risk is not the same as 0% risk, it is above 0%. Remote and unlikely, yes, but impossible, no. Read some accounts of government defaults and economic crises to say what happened to debt labeled very safe. Second issue, historical covariance is no guarantee for the future. More specifically, extreme events are more common than a normal distribution would imply. Reading The Black Swan by Nassim Taleb will fully clarify this point. This is intuitively obvious for people living near the sea or near a river. The record flood level so far is no indication and certainly no guarantee of potential flood levels in the future. It can easily be surpassed, and not by just a little bit. Why do most people understand this for nature, but fail to understand it in the context of the stock market? Let's take this beta, the historical level of sensitivity of a specific stock to market movements. General Electric, a very well-known company with a long history, is said to have a beta of 1.2. The stock is supposed to move largely in line with the overall market. Here's a graph of GE's share price percentage change versus the S&P 500 market index for 2009 through 2016. GE stock exhibits similar patterns as the overall market. Here's the same graph for 2019. A bit of a dip in the late summer and early fall for the specific stock, but if you look at the start of the year and end of the year levels and the overall pattern, reasonably similar to the overall market. Here's the point. The normal patterns don't matter if extreme events occur. In 2017 and 2018, the overall market continued to rise, while GE's share price dropped like a stone, as the hidden risk that had been building up over the years came out, and the company's financial results were hugely disappointing. Very few shareholders of GE care about the statistical beta. It's the outliers, the extreme events, that define the return. The WACC is the weighted average cost of capital. WACC is a calculation of a firm's cost of capital in which each category of capital is proportionally weighted. It sounds like a plausible idea, but has a lot of real-world issues in its application. Want to learn more about business, finance, accounting and investing? Then subscribe to the Finance Storyteller YouTube channel and start watching the next video in the recommendations on the screen. Thank you. Welcome to the Finance Storyteller series. In this video we're going to cover a key term from the world of corporate finance, free cash flow. We will take an in-depth look at common and alternative definitions of free cash flow, compare the profit view and the cash flow view of looking at the company's performance, and we will analyze the free cash flow numbers published by companies like ExxonMobil, Facebook, General Electric and General Motors. Let's get started. The first thing to be aware of is that free cash flow is a non-GAAP metric. This means it is not covered by generally accepted accounting principles, and to a certain extent, companies have some creative liberty in defining the term. If you want to learn more about GAAP versus non-GAAP metrics, then please watch my video on that topic. I will link to it on the end screen of this video as well as in the description below. Let me give you some context so you know where free cash flow fits in. There are three financial statements: the balance sheet, an overview of what we own and what we owe at a point in time; the income statement, an overview of the profit or income that you generate during a period; and the cash flow statement, an overview of how much cash you generate and where you spend your cash during a period. Free cash flow, as its name suggests, is a cash flow metric. If you look through annual reports or finance textbooks looking for a definition of free cash flow, you will often find something along the following lines. Free cash flow is that part of the total cash flow that is not required for operations or reinvestment. Free cash flow is the part of cash flow that is available for distribution among all the securities holders, debt or equity, of an organization. In other words, that part of the cash flow you could take out of the company to pay down debt or pay a dividend to shareholders without hurting its ongoing operational capability to pay the bills and without hurting the investment plan. To calculate free cash flow, you take the most comparable GAAP metric, cash from operating activities, or CFOA, and deduct capital expenditures. You can find these numbers in the cash flow statement that the company publishes in its annual report or quarterly earnings release. So you can always calculate free cash flow yourself by looking up those numbers. Some companies explicitly mention and calculate free cash flow for you. About half of the annual reports that I reviewed in preparing for this video had companies publishing their version of free cash flow. Unfortunately, the definitions that companies use are not always the same. Some stay very close to what you see here, but we will also see some alternative definitions along the way in this video. Fortunately, you've come to the right place, the Finance Storyteller channel, to learn how to make sense of this. If you look up free cash flow in an annual report, you will see that companies provide you with some context to their definition and disclaimers as to what you should be aware of when analyzing free cash flow numbers. The following sentences are part of Facebook's annual report discussion on free cash flow. We define and we have chosen clearly indicate that this is a non-GAAP metric that is not part of generally accepted accounting principles, but something that a company can choose to define in a certain way. The last sentence shown here about other companies possibly presenting similarly titled measures differently is part of a well-worded paragraph starting with the words, "Free cash flow has limitations as an analytical tool, and you should not consider it in isolation or as a substitute for analysis of other GAAP financial measures." I encourage you to look up the full text in the latest Facebook annual report. It's time to dive into the numbers and review Facebook's free cash flow over the past couple of years. Like many other companies, Facebook puts the older years on the right and the latest years on the left. If you go from 2011 on the right to 2015 on the left, you see the net cash provided by operating activities growing very quickly, especially in the 2013 to 2015 timeframe. The cash outflow for property and equipment also goes up significantly, especially in 2014 and 2015, as Facebook expands its capacity. 2015 has been a record year in free cash flow for Facebook, $6.1 billion. At the moment of putting together this video, I only have Facebook's numbers for the first 3 quarters of 2016, but those 9 months are already higher on each of the line items than the 12 months of 2015. So Facebook should have another record free cash flow year in 2016. Later on in this video, we will look at the free cash flow of companies in very different industries: General Motors, ExxonMobil, and General Electric. So does a company that is very profitable always have a very high free cash flow? That's not necessarily the case. The reason for that is that the way you measure profitability is different from the way you measure cash flow. In the profit view of a company, the matching principle is very important, matching the revenue and expenses to the period in which they occur. In the cash flow view of a company, the moment when cash is flowing in and cash is flowing out of the company is key. Let me illustrate this with some transactions. Let's assume we run a small factory that produces widgets. If we purchase raw material and we pay the supplier for it, we book a debit to inventory and a credit to cash. This transaction does not impact profitability, but it does impact cash flow. If you use the machines in the factory to produce, you book a depreciation charge in the income statement. For cash flow, depreciation is not relevant, as you do not pay depreciation to anyone, hence there is no cash outflow. If you want more explanation on how depreciation works and how it is calculated, watch the Finance Storyteller video on depreciation. If you sell goods to a customer on credit, you book the revenue and cost of goods sold of that sale when the goods are delivered and you meet all the revenue recognition criteria, the difference between the revenue and the cost of goods sold is your margin. For cash flow, this transaction does not do anything, as no cash is coming into the company yet until the customer actually pays you. If you sell goods to a customer with a cash payment, both profit and CFOA are impacted. It's only a small step from CFOA to free cash flow. Deduct the part of the cash flow that needs to stay in the company to fund new investments or replacements of existing machines. This is called CapEx or capital expenditures. It's time to start comparing some companies on their free cash flow performance. Don't jump to conclusions that a company is doing well when their free cash flow is high. They could get there by taking short-term measures like limiting their CapEx spending, which puts their longer-term financial health at risk. Analyze the numbers, see the context, and only then draw conclusions. Here's the free cash flow picture for car company General Motors. Operating cash flow in 2015 is slightly higher than that of Facebook, but due to the capital-intensive nature of the car industry, CapEx is way higher, and therefore free cash flow is far lower for GM than it is for Facebook. Now let's look at one company that is a descendant of a corporation started in 1870 and another one that was founded in 1892. ExxonMobil and General Electric. Both companies are large multinationals that in recent years have gone through large transformations of their business portfolio. The free cash flow definitions that they use reflect those strategic paths. Once again, words create worlds. The words used in defining strategy impact the world of financial metrics. If you look at the free cash flow definition of ExxonMobil, you see that they start off, like everyone else, with a line called net cash provided by operating activities. Even though this is significantly lower in 2015 than in 2014, in absolute terms, it is still very big at $30 billion. Additions to property, plant and equipment are usually between 30 and 35 billion per year, but were cut to 26 billion in 2015. The next line is one that we have not seen before in the definitions used by other companies. Proceeds from sales of subsidiaries, property, plant and equipment, and sales and returns of investments. This is a line that consistently reflects a cash inflow for the past 5 years, but should be treated with caution as you cannot keep selling parts of your business portfolio forever. You would end up with no company assets at all. Another unusual part of ExxonMobil's definition of free cash flow versus that of other companies is the line of additional investments and advances and the one below of collection of advances. Over time, these seem to largely offset each other. If you look at the free cash flow numbers per ExxonMobil's definition at the bottom, you see how dramatically the picture has changed from the 2011-2012 timeframe of having more than 30 billion in free cash flow per year to about 20% of that level in 2015 at $6.5 billion. That's the difference between oil being at $100 per barrel versus $30.
My job is to make college easier because students have a lot on their own.
Last example is General Electric. Their free cash flow has gone up in recent years. Just like ExxonMobil, in their definition, GE has chosen to add cash inflows from selling property, plant and equipment, as well as cash inflows from business dispositions. For GE, the bottom line in terms of free cash flow is the total of free cash flow plus dispositions. It's time to zoom out from definitions and numerical examples to the big question. Why is free cash flow such a big deal in the first place? Well, the reason for that is that free cash flow is a key variable for analysts and investors that try to estimate the value of a firm. The value of a company today can be seen as the cash that they currently have, plus the estimates of future free cash flows discounted back using the weighted average cost of capital to their present value. At the time of writing and producing this video, the market capitalization of Facebook is bigger than that of ExxonMobil or General Electric. A very large part of that is driven by the large potential for growth in free cash flow for Facebook. A lot of assumptions go into the valuation calculation, as estimating the future free cash flow of a company requires you not only to have an understanding of its historical performance, but also of its vision, mission, and strategy going forward, its competitive landscape, and the impact of all these on the free cash flow estimates. The further out into the future you go, the tougher it becomes to make a solid estimate. Not an easy task, and possibly an impossible one, in a world that is volatile, uncertain, complex, and ambiguous. In summary, free cash flow is a useful non-GAAP metric to look at the performance of a company, but beware of the variation in definitions that exist. Free cash flow does not come for free, as in dollar bills just dropping from the air. Companies have to work very hard to generate free cash flow. The best way to think of it is as cash flow that wants to have freedom. On the Finance Storyteller YouTube channel, you can find lots of well-researched videos explaining business, finance, and accounting topics. Please subscribe to the Finance Storyteller channel and take the time to like the video and comment below. On average, I post one new video per week. If you subscribe to the channel, you will be the first to see it.
ළමයි ඔයගේ මේ අපි ඉතුරු සුමානවල තව additionally මේ what we will do, we will discuss the additional, in order to get the additional knowledge, we will watch the relevant YouTubes. Then you will have a different kind of idea regarding the subject, because we already cover the syllabus. So what you can do, I'm repeating last couple of weeks also, ඔයගලන්ට මොන හරි ප්‍රශ්න තියෙනවා නම් මත් එක්ක කතා කරන්න පුළුවන් මේ වෙලාවේ. assignment එක සම්බන්ධව මොන හරි ප්‍රශ්න තියෙනවා නම් ඒත් කතා කරන්න. මොකද අද 23යි ලබන මාසේ 20 වෙනකොට ඔයගොල්ලෝ සියලු දෙනාම සබ්මිට් කරන්න ඕනේ මේ group assignment එකයි individual assignment එකයි. ඔයගලන්ට මොනවද තියෙන ප්‍රශ්න? තාම මොකද මේ question paper එක තාම finalize වෙලා ආවේ නැහැ. ඒක නිසා මට මේ තෝරාගත්ත topic සම්බන්ධව ඔයගලන්ට තාම disclose කරන්න බෑ. ඒක finalize වෙච්ච ගමන්ම මට පුළුවන් කියන්න මගේ මේ questions එන්නේ මේ areas වලින් විතරයි කියලා. ඒක තමයි මට කරන්න පුළුවන් දේ. මොනවද ඔයගලන්ට තියෙන ගැටලු? assignment එක සම්බන්ධ මොන හරි තියෙනවද? කොහේ හරි හිර වෙච්ච තැනක්? assignment එකම group සහ individual assignments. එහෙම නැත්නම් ආයි revision කරන්න ඕනේ තව මොන හරි topics තියෙනවද? තියෙනවා නම් මට කියන්න. Yes, Krishan. Krishan, do you have anything to say? Report for the individual assignment. 1 second. Yes, individual assignment report. Wait. Give me a few seconds. I will show you. මම assignment එකේ cover page එකේ වුණා නේද? ඔයගලන්ට ඔක්කොටම හම්බුණා නේද assignment එකේ cover page එක මම email කළා. ඒක තමයි මුලින්ම එන්න ඕනේ page එක. ඔයගලන්ට ආවද නැද්ද email එක? හරි. එහෙමනම් ඊට පස්සේ මේ assignment එකට වෙන මේ සාමාන්‍යයෙන් මේ හදාගන්න මෙන්න මේ වගේ මේ table of content එකක්. ඔයගලන්ට මම කියපු දේවල් වලින් ඒකේ තියෙන්නේ අපි කියමු මේකේ නිකන් ID එකක් ගන්න. cash inflow outflow. ඊට පස්සේ weighted average cost of capital. ඊට පස්සේ net present value statement. discounted payback period. ඒ අන්තිමටම මේ මොනවාද conclusion එක. ඊට පස්සේ why මොනවාද project එක මොකක්ද කියලා define කරන්න. ඒ වගේ topics 4ක් 5ක් දාගන්න. project මොකක්ද project එක? ඊට පස්සේ project cost එකක් තියෙනවා නම් ඒකට ඔයගොල්ලෝ calculate කරනවා නම් ඒක. ඊට පස්සේ cash inflow and outflow. ඊට පස්සේ weighted average cost of capital එක. ඒකට page number ඊට පස්සේ මෙහෙම page number එකක් එන්න ඕනේ. ඊට පස්සේ net present value statement. ඊට පස්සේ discounted payback period. එච්චරයි මම අහලා තියෙන්නේ. මෙතන ඇත්තටම අහලා තියෙන්නේ cash inflow එකයි outflow එකයි weighted average cost of capital එකයි net present value එකයි discounted payback period එකයි. මේ අනිත්‍යව බලන්න එපා. මේක මේ වෙන තැනකින් මගේ වෙන assignment එකකින් ගත්ත එක. ඊට පස්සේ conclusion එක. මොකද්ද ඔයගොල්ලන්ගේ conclusion එක කියලා. ඊට පස්සේ report එක කියන එකේ දැන් මේ level එකට මේ තියෙන masters level වලට ඒකට අවශ්‍ය නැහැ. මම මේ පෙන්නන්නේ සාමාන්‍යයෙන් master level එකේ report එකක් මේක ඇත්තටම ඔයගොල්ලන්ට වැදගත් වෙනවා master level එකේ නෙමෙයි fourth year ආවට පස්සේ dissertation එකට මේක වැදගත් වෙයි මේ format එක. නිකන් ඔලුවට ගන්න. executive summary එකක් තියෙනවා. ඉතින් project එකේ viability එක ගැන වෙනම ලියනවා. ඊට පස්සේ මේ investment appraisal එක. ඊට පස්සේ project එකේ අපි කියමු project cost එක දැන් මේ තියෙන cash inflow outflow අර කියන දැන් ඔයගොල්ලෝ හදනවනේ workings ටික ඒක එහෙමම copy කරලා දාන්න මේකේ මේ තියෙන cash inflows and outflows මොකද්ද project එක අවුරුදු 5ට අවුරුදු මේ තියෙන ඔය විදිහට 1 2 3 4 5 ඒ ටික දාන්න එතකොට හරි ඊට පස්සේ conclusion එකක් එනවනේ අන්තිමට right ඊට පස්සේ assumptions ටික දාන්න මොනවද ඔයගොල්ලෝ ගත්ත assumptions කීලිවල මේ cash inflow outflow වලින් යටින් ඊට පස්සේ දැන් මම ඔයගලන්ට දීලා තියෙනවානේ weighted average cost of capital එක calculate කරන්න ඕනේ formulas ටික. ඒකේ මෙන්න මේ කොටස විතරක් මෙතෙන්ට ගන්න. ඔය ඉතින් weighted average cost of capital කියන්නේ මොකක්ද? දාලා ඉවර වෙලා මේ detail working එකක් යටින් පෙන්නන්නේ අන්තිමටම report එකේ යටින්. නැත්නම් මට calculations හොයන්න බැරි නිසා. දැන් මේකේ මම ලියලා තියෙනවා for the NPV calculation purpose the weighted average cost of capital discounting factor will be taken as 11% කියලා. Detailed working as mentioned in appendix page 19. ඔක අන්තිමට පෙන්නන්න මේ කොතනද කියලා ඊට පස්සේ assumptions. දැන් මම කියවනේ පළවෙනි assumption එක වෙන්න ඕනේ the audited account stated in the annual report shows as the market value of equity and debts. ඔයගලන්ට මම දෙතුන් සැරයක් ඒක කියන්නේ. ඊට පස්සේ tax rate එක ගැන interest rate ඔයගොල්ලෝ banks වලින් ගත්ත ඒවා. ඊට පස්සේ මේ ඔය ටික දැම්මහම ඇති. ඊට පස්සේ මේ තියෙන net present value statement එක Excel වලින් copy කරලා ගන්න එක මේ copy කරන්න මේ Word document එකට මට ඒවද PDF කරලා එවන්න. ඒක ලේසි. PDF එවන්න මට ඒවද. ඊට පස්සේ net present value statement එක ඔය විදිහට. ඊට පස්සේ discounting payback method එක. හරිනේ. ඊට පස්සේ discounting payback method එක මේ තියෙන 4 years. හරි. ඊට පස්සේ අන්තිමටම ඔයගොල්ලෝගේ ප්‍රොජෙක්ට් එක feasible ද නැද්ද කියලා ඉවරලා වචන 100කින් විතර ලියලා දාන්න ඇති. මේක මේ ඊට වැඩි comprehensive මේ එකක් නේ ගොඩක් දේවල් තියෙනවා. ඒ නිසා එච්චර අවශ්‍ය නැහැ. අපි බැලුවොත් එහෙම ප්‍රශ්නේ ආපහු සැරේ එකක්ද අපි ප්‍රශ්නෙට අහලා තියෙන්නේ කියලා. හරි. මම ඔයගොල්ලන්ට මෙතන මේ උගන්වන්නේ අන්තිම 4th year එකට ආවට පස්සේ ඔයගොල්ලන්ගේ ඩිසර්ටේෂන් එකක් තියෙනවා. ඒකට අවශ්‍ය කරන ඩිසිප්ලින් එක තමයි දැන් මම මේ උගන්වලා තියෙන්නේ. ඒකට ඔයගොල්ලෝ දන්නවා. ඒකයි මේ දේවල් ඔක්කොම කියලා තියෙන්නේ. මේ තියෙන්නේ. sorry මේක අහලා තියෙන්නේ මේ weighted average cost of capital එක විතරයි ළමයි මම අර කිව්වේ group assignment එකේ එක. Choose 5 different companies listed in Colombo Stock Exchange and calculate the weighted average cost of capital of cost of capital your calculated must be based on latest 5 years annual report. I'm sorry මම වැරදි එක explain කළේ. එතකොට මේ දැන් අර පෙන්නපු එක තමයි group assignment එක. කොහොම හරි ඕගොල්ලන්ට අවශ්‍ය දේ තමයි පෙන්නලා තියෙන්නේ. දැන් මේක ඇවිල්ලා weighted average cost of capital එකේ formula එක copy කරලා දාලා අන්තිමටම ඔයාගේ conclusion එක ලියන්න. තෝරාගත්ත කම්පැනි මොනවද කියලා මුලින්ම ඉන්ට්‍රොඩක්ෂන් එකක් දාන්න වචන 100කින් 200කින්. බය වෙන්න එපා මේ හදලා එවන්නකො. එතකොට ඔයගොල්ලන්ට ID එකක් තියෙනවනේ. මොකද්ද වෙන්නේ කියලා. ඊට පස්සේ ඒ කම්පැනි පහේ මේ weighted average cost of capital එක අපි කියමු නවලෝකේ. නවලෝක ඊට පස්සේ ආසිරි. දැන් නවලෝක group එකේ අවුරුදු 5ක ඇනලයිස් කරනවා. ඊට පස්සේ ආසිරි එක ඇනලයිස් කරනවා. අපි කියමු ඊට පස්සේ central finance. ඔය වගේ තෝරාගත්ත කම්පැනි. එතකොට සේව් කරගෙන යන්න මේ Excel එක copy කරලා අරගෙන. එච්චරයි. මොකද presentable format එකකට හදන්න. මම ඒකනේ format එකක් දීලා නැත්තේ. ඔයගොල්ලෝ හිතන suitable format එකකට දාන්න. දාලා ඉවරලා අන්තිමටම conclusion එක දාන්න weighted average cost of capital පහම compare කරලා ඉවරලා. ඔයගොල්ලන්ට තේරෙනවනේ weighted average cost of capital එකත් එක්ක මේ ඒ කම්පැනි පහේ ඉවැලුවේෂන් ගැන ඔයගොල්ලන්ට තේරෙයි. මම මේක දැන් කියන්නේ නැහැ. ඔයගොල්ලෝ බලලා දාන්න මොකද්ද ඔයගොල්ලෝ තෝරගන්න හොඳම කම්පැනි කියලා ඉවරලා WACC වලින්. ඒක තමයි මේ assignment එකේ purpose එක. පළවෙනි එක calculation එක familiar වෙන එක. මේ ඇත්තටම මේ assignment එකේ individual assignment එකේ හෝ group assignment එකේ මගේ බලාපොරොත්තුව lecture ඔයගොල්ලන්ගේ lecture විදිහට පළවෙනි කාරණේ ඔයගොල්ලෝ annual report කියවන්න ඔයගොල්ලන්ට පුරුදු කරන එක. දෙවෙනි කාරණේ annual reports වල ඒ figures ගන්න තැන් පිළිබඳව ඔයගොල්ලන්ට familiar කරන එක. ඒක නිසා තමයි මෙච්චර මේ annual report 20ක් කියවන්න කියලා දීලා තියෙන individual assignment එකේ. ඒ individual assignment එක කරනකොට ඔයගොල්ලෝ annual report 20ක් කියවලා තියෙනවා. එතකොට ඔයගොල්ලෝ different ඒ කියන්නේ කම්පැනි පහක් එතකොට. sorry කම්පැනි පහක. ඒකට ඔයගොල්ලන්ට ලොකු අවබෝධයක් එනවා. ඒ කම්පැනි වල share capital එක කොච්චරද profit එක කොච්චරද ඒ දේවල් ගැන ඔයගොල්ලන්ට ලොකු අවබෝධයක් එනවා. අන්න ඒක තමයි අන්තිමටම lecturer කෙනෙක් විදිහට මට වැදගත් වෙන්නේ. මොකද ඔයගොල්ලෝ මොන field එකේ මෙතනින් එහාට finance special හෝ වෙන මොනම field එකකට ගියත් ඔයගොල්ලන්ට අවබෝධයක් තියෙනවා. මොකද annual report එකක් හදනකොට කම්පැනි HR හැමෝම involve වෙන්න ඕනේ මේ process එකක්. හැම department එකම involve වෙනවා. ඒතර ඔයගොල්ලන්ට අවබෝධයක් තියෙනවා. ඒකේ format එක සම්බන්ධව. ඉතින් ඒක උගන්වන එක තමයි ඇත්තටම මේ assignment එකේ තියෙන්නේ. මේක නැත්තම් මේ මොනවාද මේ මොඩියුල් එකේ පරමාර්ථය ඒකයි. ප්‍රැක්ටිකලි කොහොමද මේක වෙන්නේ කියන එක. දාලා කැල්කියුලේට් කරලා ගන්න. කොහොමද right or wrong answers කියලා දෙයක් නැහැනේ. ඔයගොල්ලෝගේ assumptions උඩ ඔයගොල්ලෝ හිතන විදිහ අනුව තමයි ඔක්කොම තීරණය වෙන්නේ. හරි. තව මොන හරි ප්‍රශ්නයක් තියෙනවද? පැහැදිලි මදිද මං කියපේ? මම හිතන්නේ මම assignment දෙකම එකට explain කළා කියලා තමයි මට හිතෙන්නේ. වෙන මොනවාක් ප්‍රශ්න නැත්නම් පර්සනලි මට මොන හරි ප්‍රශ්න තියෙනවා නම් කෝල් කරලා අහන්න මගේ නම්බරේ ඔයගොල්ලෝ ගාව ඇතිනේ. මොන හරි ගැටලු තියෙනවා නම් මාත් එක්ක අහන්න. එහෙමනම් මම ලෙක්චර් එක නවත්තලා මේ අප්ලෝඩ් කරන්නම් LMS එකට ටික වෙලාවකින්. ඕකේ.